Hey everyone, welcome back to my financial focus. In this video, I'm going to be talking about Amazon and the recent news that came out about their 20-for-1 stock split. I'm also going to be doing a little bit of an analysis of the business by looking at their financial statement. And then lastly, I'm going to be doing a discounted cash flow analysis to figure out what the intrinsic value of Amazon is, so we could figure out what price would be a good price to buy into Amazon from a value investing perspective. So just to start off, we can see Amazon recently announced a 20-for-1 stock split and a $10 billion buyback, which is the first one they've announced since 1999. And we can see that once the 20-for-1 stock split is implemented, the stock will be trading at about $130 per share if it's still trading at this share price when the stock split happens. And that's going to be pretty interesting for a lot of investors who are looking to do things like trade options on Amazon, because it's a lot easier to buy 100 shares at $130 per share as opposed to 100 shares at like $2,000 or $3,000 per share. And obviously with options, when we're dealing with options, we're dealing with 100 shares. So if someone wants to make money profiting from cash secured puts or covered calls or through spreads and things like that, it's going to be a lot easier to do that after these shares are only worth $139 each. And also, if I scroll down a little bit here, we can see the date that it'll take place in. The stock split is going to take place on June 3rd, and then as of June 6th, the stock will start trading at its split adjusted basis. And since the recent stock split, the stock has actually increased by 4,300%, and that's basically over the last 2 decades or so. And so now I'm going to get into a little bit for how Amazon actually makes their money and how they produce their different revenues from their different revenue streams, so that we could figure out what Amazon actually does, because it's important to know what we're actually buying if we're going to be investing into a company. So to start off, we see right off the bat that their main revenue source comes from selling products on their online stores as well as in some of their retail locations. And then they also sell a service where they allow third-party sellers to sell products on their platform through things like Amazon FBA or Fulfillment by Amazon. And they basically make money this way by charging commissions and fees for their seller services. They also provide subscription services from things like Amazon Prime memberships, as well as through Twitch, which is another subsidiary of Amazon. And then they also provide advertising services where they allow different entrepreneurs and companies to advertise their products and services on Amazon's pages. And then lastly, they offer their Amazon Web Services, AWS, which is basically a service that they sell at a standalone price, and it provides things like cloud storage and other digital services and things like that. And this is actually one of the biggest parts of their business that's growing the fastest at the moment. And so this is probably going to be the part of their business that ends up increasing their profitability in the future. And we can see that when we go to their financial statements right here with their income statement. We see that they break up their income statement into 2 parts, net product sales and net service sales. And we can see that most of their sales come from their net product sales at the moment, which is like their products that are sold on their retail stores and on their online stores right here. And then their net service sales comes from things like Amazon FBA as well as from their AWS service sales. And we can see that the total revenue for 2021 came out to be about $469 billion. And that's up from about $386 billion in 2020. So that's quite a bit of revenue. But unfortunately, we see that their operating expenses are extremely high, and they end up only being left with about $20 billion of operating income. And actually in 2021, their operating margin was only 5.3%. So basically, of the almost $500 billion of revenue that they acquired, they were only able to profit after expenses by about 5%. And that's actually down from 2020 when their operating margin was 5.9%. And that mainly came as a result of the global events that were occurring, as well as the fact that their operating expenses increased, but their net sales did not increase at the same rate that their operating expenses did. And also, if we see right down here, we can see their net profit margin for 2021 was actually higher than their operating margin, and that mainly came as a result of this increase in operating income, which came out to $14 billion in 2021, up from only $2 billion in 2020. And so their net profit margin was actually 7.1% for 2021, and then it was 5.5% for 2020. So it's tough to say whether or not they're going to be able to actually continue to increase their net profit margin because of the fact that their net profit margin for 2021 came from this other income column. But time will tell in that regard. And we can actually get an even better look at their income and revenue streams by looking at this more detailed income statement right here on page 23 that shows their net sales broken up by each operating segment: North America, International, and AWS. And we can see that from these growth rates down here that their North American operating segment did not grow at a faster rate in 2021 in comparison to 2020. In 2020, it grew at about 30 to 40%, and then in 2021, it only increased by about 18%. But their AWS segment of their operations actually did grow faster in 2021 at 37% in comparison to only 30% in 2020. So again, this is probably one of the main parts of their business that's going to carry their profitability into the future. And then right down here, if I scroll down, we can see their consolidated balance sheet. And we can see that most of their business is actually financed by debt as opposed to equity. We can see that because their total assets for 2021 came out to be about $420 billion, up from about $300 or so billion in 2020. But their total equity was only about a little over $100 billion in 2021, and it was about $90 billion in 2020. And so their debt to asset percentage for 2021 was 67.1%. And so we can see that most of their business is actually financed by debt as opposed to equity. And lastly, we can see their statement of cash flows right here, which is going to lead us into the discounted cash flow analysis to end off the video to figure out the intrinsic value of the business. But basically, from this, we can see that their operating activities declined from 2020 to 2021. We can see that in 2020, it was about $66 billion in operating cash flows. And then in 2021, it was only about $40 to $50 billion. And that decline mainly came from an increase in their accounts receivable balance, which is basically meaning that they were paid in credit, but they didn't actually receive the cash as of this end date in 2021 for the transactions that they incurred over this year. And also their cash flows from investing activities increased pretty substantially, especially for their purchase of property and equipment, which is a capital expenditure, which is going to impact their free cash flow. And then also from their financing activities, we can see that they primarily raised more money from their financing activities in 2021 as opposed to in 2020, where they paid back a lot of the capital that they owed to borrowers and lenders and things like that. And lastly, for their discounted cash flow analysis, we can see right here that I left a little note right here pointing out that in 2021, their free cash flow was negative $14.73 billion due to a decrease in cash flows from operating activities and an increase in capital expenditures, which is the purchase of property, plant, and equipment. And so as a result of that, I chose not to actually use the 2021 year one free cash flow. Instead, I used the 2020 year one free cash flow, mainly because if I use a negative amount, then this entire model just wouldn't be able to compute an intrinsic value properly. And that's one of the disadvantages of the discounted cash flow model. It works off of a lot of different assumptions. So it's not a perfect model, but it is a model that we can use to, or mainly just as a tool that we can use to contribute to our analysis of the intrinsic value of companies. And so I got most of these values from Yahoo Finance as well as from TradingView, like the projected growth rates by different estimates and analysts on Yahoo Finance. And then also I got the net cash minus the net debt from their balance sheet. And they currently have more debt on their balance sheet than they do cash. And so we can see, based on these values, also by dividing it by their 508 million shares outstanding currently, we can see the intrinsic value comes out to be about $2,329 per share with a 30% margin of safety of $1,600 per share and a 50% margin of safety of $1,100 per share. And compared to their current share price of $2,900 per share, we can see that this currently puts Amazon at a bit of an overvaluation if these growth rates from Yahoo Finance are to be believed. And so, unfortunately, it looks like Amazon's share price might have to drop a little bit more in order for it to present a good buying opportunity. But I would definitely love to know what everybody watching this video thinks. If Amazon is currently a buying opportunity or a sell, let me know in the comment section down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.